Hi folks, now let's finish off our problem and prepare the consolidated income statement and calculate the consolidated retained earnings balance at the end of year 10. Well, now that we've gone through the calculation of consolidated net income, you can see that our check digit down here when we calculate consolidated or when we show consolidated net income on the statement itself, it does match what we said it should be. So now let's see how we got that number, or how we got that number through this process of constructing the statement. First of all, we know consolidation is additive. We add the sales of the parent or the sub to the sales of the parent. That's exactly what we're going to do here. We have sales and other income of each separate entity added together, but notice we've deducted $600,000. You'll remember that in the question, during the year, the parent had sold inventory to the sub in year 10 amounting to $600,000. Two things. Number one, that's an intercompany transaction. So we know that sales revenue can't be legitimately booked by the consolidated entity. Even though the separate entity of the parent's fine, the consolidated entity can't book it because it's intercompany. So now how does that affect the sub? Well, quite simply, when the parent sold that $600,000 in $600,000 worth, or booked $600,000 worth of sales revenue, when it sold that inventory to the sub booked that $600,000 as purchases, right? Which is part of its cost of goods sold. So the idea is it was sitting in its cost of goods sold. So therefore, what would we have to do? We would have to eliminate it in the sub's cost of goods sold and in the parent's sales. So that's why we have a reduction of sales revenue here. That really relates to sales revenue of the parent and cost of goods sold of the sub. That's theirs. Now, if you went back, and I don't know how many of you really care to do this, but I like to do it. I know when I do the course in the classroom, I always show the students what the entries would look like in the consolidation worksheet. On the worksheet, so that the parent doesn't pick up, or the parent when they're preparing the consolidated statements doesn't pick up those intercompany sales during the year, they would adjust their revenue downward by $600,000, and again that's the P, so you know that's the parent sales revenue, and the sub's cost of goods sold would be adjusted downward by $600,000. Right? Because that's what would have gotten booked. So again, you can see one account is for the parent, one account is for the sub, so therefore it can't be on any separate entities books. This can only be in the third set of books, the consolidation worksheet. So therefore, that's where we get these $600,000 amounts. You'll also notice there that the parent has eliminated the intercompany dividend of $560,000 as well. You remember in a previous lesson we talked about why that's the case. Don't forget that $560,000 was intercompany. It was the dividend that the parent got from the sub, so it can't be included as part of its consolidated income calculation because it's intercompany. So now we'll deduct that out of there and we'll get $40,640,000. Cost of goods sold here again needs to be adjusted not only for this year's intercompany sale, but don't forget, I'm just going to squeeze up here where we get the beginning inventory amount. Don't forget this was the intercompany profit analysis we did in the very first video and that we alluded to in the second one as well, right? So now we talk about here the fact that we have to bring in to consolidated income on a pre-tax basis $30,000. So how would we do that? Well, the way we would do that is we would adjust the cost of goods sold of the consolidated entity when we're calculating it downward. That when you reduce an expense, that increases profit, right? So the idea is we're going to reduce the cost of goods sold to bring it in. When we bring in this profit into year 10, we also have to book income tax expense from a consolidated perspective. So you can see here we're increasing the income tax expense that the consolidated entity would book as well. The other thing we said we would need to do is adjust after-tax income by $18,000. But clearly you can probably see that by reducing this expense and increasing this expense, at net, what have we done? We've taken in, when we net out this $30,000 pre-tax increase with this $12,000 income tax expense, we actually increase after-tax income by, at net, $18,000. So that adjusts part of our cost of goods sold, as well as our income tax expense. when we look at the beginning inventory transaction, right? Or the analysis, I should say. If you want to look at the worksheet entries for that, be my guest. This is the one we looked at initially when we did our first video, right? When we were doing our intercompany analysis, our profit analysis. This is the worksheet entry that P would make on the consolidated books to reduce cost of goods sold to book the profit. It would book the tax expense into consolidated net income, and we would also adjust our opening balance of retained earnings. We're going to get to this in a minute, but the idea is here, this is where we'd actually be booking our after-tax profit into consolidated income, right? There's your $18,000 adjustment there. And this is where we see it on the actual statement, right here, between these two amounts, right? Now we also have to look at the fact that we had an ending inventory. We also had profits. So how is that going to affect cost of goods sold? Well, we said that we can't recognize that pre or post or after tax profit into consolidated income because that profit can't be booked until year 11 when the sub who received the goods sells it to a third party. So we have to eliminate that intercompany profit from our consolidated income statement. So how would we do it? Well, we already know that pre-tax, the parent booked $135,000, so we would increase cost of goods sold to remove the profit, and we would also have to remove from the consolidated books income tax expense of $54,000. Why? Because that's part of the income tax expense that the parent would have booked. Because don't forget, they booked this pre-tax profit and that tax expense separate entity, but the consolidated entity can't book it until the sub sells it outside. So we're going to reduce the tax expense there by $54,000 because we can't take in the pre-tax profit of $135,000. So that adjusts our cost of goods sold to $25,705,000. And by walking through these a series of adjustments, we're also going to get income tax and other expenses of $5,758,000. Now what we see is our depreciation expense. There was no adjustment to depreciation this year. It sits at $5.2 million. So we're going to have total expenses of $36,663,000, and that would give us net income of $3,977,000 once we take our sales revenue and deduct our total expenses. The attribution here, you can see, can get quite ugly in a sense, especially when you're calculating the shareholders of the parent. I think it's much easier to do it where we did it in the second video and just look at it when we calculate consolidated net income. It's a little clearer to the student there, I think, what the number should be. So again, if you just want to scoot up there just to take a look, don't forget, we already calculated consolidated net income, okay, in part by calculating the subs adjusted income, and then adding to that the parent's share of the subs adjusted income, and that would give you $3,557,000. I just think this is a much more straightforward way of coming to L's shareholder's share of consolidated income instead of doing it down here. So you could take these numbers here that I'm pointing to, you could take them from your calculation of consolidated net income when you did the attribution up there. Now the last thing we're going to do here is to calculate the ending balance of consolidated retained earnings. Now, we can do this the same way we calculated our consolidated net income. Start with the two separate entity balances. But here, because we're calculating retained earnings, we are going to start with the parent's separate entity retained earnings at the end of the year, which is given in the question as $13,200,000. But don't forget, we already know that we have to deduct any unrealized profit that was sitting in the ending inventory of the parent. Why? Because that represents profit that was booked in year 10 that got closed out to the parent's retained earnings. So at the end of year 10, after the closing process, the parent's retained earnings includes this $81,000 that we can't legitimately book into profit until year 11. So therefore, if we had to adjust it out of income, we also have to adjust it out of the separate entity retained earnings of the parent. There are no other adjustments to be made to the parent's retained earnings. Don't forget the intercompany sale that happened in year 9 that the parent made. All of that by the time we get to the end of year 10 is legitimately booked into the parent consolidated income. So, and that's already been booked in to the retained earnings at the end of year 10, because don't forget the parent would have booked that separate entity in year 9 into its income and closed it out to its retained earnings then. So by the time we get to the end of year 10, we don't have any issues with year 9 intercompany inventory sales because it's all legitimately booked by the parent. So the consolidated entity can already book it. So we don't have to make any adjustments for that. So now the next series of adjustments we'll look at is to look at what happens to Bo, the sub's profit or retained earnings. Bo's separate entity retained earnings at the end of year 10, and the question is $10,400,000. But don't forget, the parent we can only take into consolidated consolidated retained earnings the parent's share of any post-acquisition retained earnings of the sub. And by that we mean if there were any retained earnings that the sub earned before they became related to the parent can't lay any claim to that. So we are deducting here $6 million in retained earnings that the sub had at acquisition, the date they became related. So only $4.4 million in post-acquisition retained earnings can be claimed by the parent, but only at its share. So we've got a change in retained earnings or post-acquisition retained earnings of the sub that the parent can take in at its share at $4.4 million. However, don't forget, there was also that land sale that took place in year 8. With that land sale, you'll remember that the sub had booked $60,000 in its after-tax income in year 8. You'll remember that right here. That's the $60,000 that they booked in year 8. However, don't forget, because that land has not been sold outside yet, we cannot recognize it in any consolidated accounts. That is the profit on that intercompany land sale. So therefore, if it can't get booked into income along the way since it was sold intercompany from a consolidated perspective into income, we cannot book it into consolidated retained earnings. So don't forget, part of this $4.4 million is going to include that $60,000. So because the consolidated entity can't recognize the profit, it can't recognize it in retained earnings either. So we're going to remove it. And again, we'll wind up now with adjusted post-acquisition retained earnings of $4,340,000. 70% of that is $3,038,000. So our consolidated retained earnings at the end of year 10 would be $16,157,000. So this concludes our presentation of the consolidated income statement and the calculation of consolidated retained earnings. I hope you found the video helpful.